If your goal in investing is to build wealth while also earning a steady stream of income, dividend ETFs are one of the smartest tools you can use. Many investors focus only on growth stocks, hoping their investments will increase in value over time. But experienced investors often rely on dividend strategies because they provide two powerful benefits at the same time: consistent income and long-term portfolio growth. While dividend ETFs allow you to earn regular payouts from some of the strongest companies in the market while also benefiting from stock market appreciation. In today's video, we'll explore the top 3 dividend ETFs that many investors consider reliable options for building passive income. These ETFs are designed to invest in companies that regularly pay dividends, meaning shareholders receive a portion of the company's profits. Over time, these payouts can become a powerful source of income and wealth accumulation. The 3 ETFs we'll cover today are Vanguard High Dividend Yield ETF, VYM, iShares, Select Dividend ETF, DVY, and Schwab U.S. Dividend Equity ETF, SCHD. Each of these funds follows a slightly different strategy, but they all focus on high-quality dividend-paying companies. Vanguard High Dividend Yield ETF, VYM. The first ETF on our list is the Vanguard High Dividend Yield ETF, commonly known by its ticker symbol VYM. This ETF focuses on large, established U.S. companies that offer above-average dividend yields. Instead of chasing extremely high dividends that may be risky, VYM targets stable companies that have strong histories of paying reliable dividends. Many of the companies included in VYM are well-known global brands with long operating histories. Examples include companies like Johnson Johnson, Coca-Cola, and other major corporations that generate consistent profits year after year. These types of companies often operate in industries such as healthcare, consumer goods, financial services, and energy. One of the key advantages of VYM is diversification. Rather than investing in just one dividend stock, investors gain exposure to hundreds of companies in a single ETF. This reduces the risk associated with any single company experiencing financial trouble. VYM is particularly popular among long-term investors and retirees who want steady income without constantly managing individual stocks. Because it focuses on financially stable companies with strong dividend records, VYM offers investors a balance between income and growth. This makes it a solid foundation for anyone building a dividend-focused portfolio. Shares Select Dividend ETF, DVY. The second ETF on our list is the iShares Select Dividend ETF, known as DVY. This ETF takes a slightly different approach compared to VYM. Instead of simply focusing on companies with high dividend yields, DVY specifically targets companies with a long and consistent history of paying dividends. These companies often have strong balance sheets, stable cash flow, and reliable earnings. In other words, they are businesses that have proven they can maintain dividend payments even during challenging economic periods. Because of this focus on stability, DVY is often considered a strong option for investors who prioritize income reliability. DVY includes companies from a variety of sectors, such as utilities, industrials, financials, and consumer services. Many of these industries are known for producing steady cash flow, which allows companies to maintain regular dividend payments. Another important advantage of DVY is that it typically provides quarterly dividend payouts. This means investors receive income multiple times throughout the year, creating a predictable cash flow stream. For individuals who rely on investment income, such as retirees, this predictable schedule can be extremely valuable. Overall, DVY is ideal for investors who want a dependable income strategy and prefer companies with proven dividend histories. Schwab U.S. Dividend Equity ETF, SCHD. The third ETF on our list is one of the most popular dividend ETFs among long-term investors. Schwab U.S. Dividend Equity ETF, or SCHD. What makes SCHD unique is its focus on high-quality dividend-paying companies with strong financial fundamentals. Instead of only looking at dividend yield, SCHD evaluates companies based on factors such as revenue growth, profitability, and low levels of debt. This strategy helps SCHD select companies that are not only paying dividends today, but also have the financial strength to continue paying and potentially increasing those dividends in the future. The ETF includes many large and financially stable corporations across industries such as technology, healthcare, consumer goods, and financial services. Because of this diversified exposure, SCHD provides investors with both income and long-term growth potential. Another reason SCHD is widely respected among investors is its relatively low expense ratio and strong historical performance. Many investors view it as a balanced ETF that combines dividend income with the possibility of capital appreciation over time. Why Dividend ETFs work? Dividend ETFs have become increasingly popular because they offer multiple benefits in a single investment. First, they provide regular income through dividend payouts, which investors can either withdraw or reinvest. Second, dividend ETFs offer built-in diversification. Instead of relying on a single company to generate income, investors receive dividends from many companies within the ETF. This spreads risk and creates more stability. Perhaps the most powerful advantage is compounding through reinvestment. When dividends are reinvested, they purchase additional shares of the ETF. Over time, those new shares also generate dividends, and which leads to exponential growth. Historically, reinvested dividends have accounted for a significant portion of long-term stock market returns, often contributing more than 50% of total gains. Let's look at a simple example to understand how dividend ETFs can grow wealth over time. Imagine investing $10,000 in SCHD, which has an average dividend yield of around 3%. This means you could earn approximately $300 per year in dividend income. If those dividends are reinvested instead of withdrawn, they purchase additional shares of the ETF. Over time, this reinvestment effect compounds. As the number of shares increases, the total dividend income also grows. Combined with potential market growth, this strategy can significantly increase the value of your investment over the long term. Dividend ETFs are a powerful tool for investors who want both passive income and long-term growth. Instead of selecting individual dividend stocks, ETFs allow investors to access a diversified portfolio of high-quality companies in a single investment. The three ETFs we discussed today, VYM, DVY, and SCHD, are widely recognized for their reliability, diversification, and consistent dividend strategies. Each one offers a slightly different approach, but all of them focus on financially strong companies that regularly reward shareholders through dividends. By including dividend ETFs in your investment strategy, you can build a portfolio that not only grows over time, but also generates a steady stream of income. If you want to start earning smarter income from your investments and learn more about strategies that build long-term financial freedom, make sure to like this video, subscribe to the channel, and share it with friends who want to grow their wealth and create passive income through smart investing.